And what it was, it involved a number of very sophisticated hedge funds in the US. And they're called quant hedge funds, so they have lots of highly physicists and mathematical people, statisticians. They're highly sophisticated. They're using mathematical algorithms to try to tweak or kind of take small profits out of the market over and over very rapidly in time. But in the first week of August, about a dozen of these funds suddenly, within 1 week, lost a big fraction of their profits. A couple of them went under. There's a fund run by Goldman Sachs, which is probably the market leader. It had made huge profits over several years, and then in 1 week it lost almost 50% of everything it had made. And in fact, the events took place within a couple hours on 2 different days, 2 different Mondays, 2 hours on each day. Something drastic and unexpected happened. What could have happened in this event? So there's a model that's been developed in the spirit of these market models of adaptive agents who make decisions and learn as they do, to try to understand what could have happened here. So the 3 authors are on the lower right-hand corner. What's interesting is there's one economist, there's one physicist, and there's one guy who has a PhD in both physics and economics. So this is the kind of coming together of these fields, recognizing the potential of this new idea. So in this ecology of the hedge fund market, here's what happens. So hedge funds, what they try to do is they try to identify opportunities in the market. So they find a stock that is valued at $1 currently on the market, but they think realistically it ought to be $1.50. It's worth $1.50. So they will buy up that stock and then wait, thinking, well, when it goes up to $1.50, we'll sell it and we'll make a big profit. But they can make a profit that way with their own money. But to make bigger profits, what they do is they borrow lots of money from banks. So they'll borrow 100 million from the bank and buy 100 million worth of that stock, knowing that when it goes up to $1.50, they'll sell and make a huge profit and then pay that 100 million back to the bank. So this is called leverage. It's the way they try to amplify their gains. Unfortunately, it also means that it amplifies their potential losses if things don't work the way they expected. I'm sorry, the dark green circles are hard to see. Those are banks. So the banks loan to the hedge funds. The hedge funds buy assets if they can identify a system where they think they can make some money. And then there's investors who invest in the hedge funds. But they don't invest in any hedge fund. They invest in the ones that seem to be doing well and making money. And if one hedge fund starts to outcompete another, then investors will flock to that hedge fund. So there's a great competition between hedge funds and to get good returns. And therefore, this means there's a great competition between hedge funds to keep borrowing ever more from the bank to amplify their profits a little bit more than the next guy. And what this model shows, again, it's a computer model that's developed just to capture in a simple way this basic logic. It shows that if you start out and stock prices in this model at first are fluctuating in a kind of fairly calm way, as time goes on and the hedge funds compete and ratchet up their leverage, the system gets pushed across a threshold into a regime where suddenly prices are fluctuating in a very wild and unpredictable way. I can show you one graph that comes out of one particular simulation of this system. What this shows is the capital flow, that is the money flowing into and out of a hedge fund, one particular hedge fund, from the investors who invest in that hedge fund. And so you find there's just activity all the time, but at certain moments there's just enormous activity. On one day, the hedge fund investors pull out 60% of all the funds they invested in that fund. And why? Because some other fund has started doing slightly better. And the investors want to capture that profit. They pull it all out and they give it to the other guy. And so in this regime, you get this wildly unpredictable fluctuation, intense competition between hedge funds, all pushing the system up toward higher and higher leverage. And then trouble strikes. So in these simulations, you find that hedge funds make enormous profits over a long period of time. And what this shows is each different color is a different hedge fund that shows the profit the ones that are higher are making more profits than the ones that are lower. They're all doing quite well until a certain time comes when everything collapses. The system just goes like a kind of explosion happens. All the hedge funds either go out of business or they lose a large fraction of their money and afterward the market's in a kind of panic and a crash state. The interesting thing is to question, what is the dynamic that makes this sudden collapse occur? And this can be explained, and the logic is actually quite simple. So all these hedge funds have gotten themselves in a real state. They're using lots of leverage. They're borrowing enormous money from the banks. They're making huge profits. So everything's good. But then something can go wrong. So suppose that lots of little investors, right? So these hedge funds have bought up this asset. Call it IBM stock. It's undervalued. They've all bought it up in large amounts. They're waiting for it to go up in value. But now some stupid individual investors come along and they sell IBM stock, which you shouldn't do, but they do, which drives the value of IBM stock down even a little further. Well, this is bad because hedge funds have borrowed a lot from the bank. And of course, the bank is wanting to protect its assets as well. It's given a big loan. And so what it does is it's called making a margin call. So if hedge funds have a certain amount of assets, they can borrow a certain amount. If those assets go down in value, such as this IBM stock, they then have to pay back some of the loan. The bank says, you better pay back some of the loan now. So how do they do this? Well, they do it by selling some of the asset. So they sell some of the asset. Hedge fund, forced to make a margin call, sells some of the asset. Well, what happens when an asset is sold? It drives the value of the asset down. So, and these hedge funds are big players, so they sell a lot of the asset. The asset value falls, which means all the other hedge funds now, which are relying on the same asset, their total wealth is now lower than it was before. And the bank says they also have to make margin calls. So when they do this, they sell the asset, which drives the asset value down further. And you get this explosive feedback where all the hedge funds are feeding it on each other, selling the asset like crazy, basically, eating their own bodies, if you will. And it all collapses very quickly, 2 hours for hedge funds that have been in existence for 20 years making enormous profits. So this is a very interesting dynamic. It's a feedback that no one would have predicted at the outset. It didn't, even the very sophisticated people running these funds didn't see this coming. And yet it's something that kind of pops up out of the background, and you have to understand these things if you're going to be able to even have a hope of kind of stabilizing markets in an intelligent way. So there's a great deal of work ongoing now and lots of arguments between physicists who model these kind of nonlinear systems with lots of feedbacks and regulators and economists who would like kind of to stick with the old methods and that can't really capture this kind of information. And it's a question as to how much of the kind of new perspective on what we need to understand these kind of patterns will eventually get put into the new kind of regulations. But it's clear that these kind of things happen and are very important. So just as a reference, anyone who wants to read more about this particular story, there's some finance experts who looked into all the empirical details of how this quant meltdown happened. And you can find this on the web. If you go to the website of Andrew Lowe, who's a particularly interesting guy, you can find it there. So just to conclude, I've talked about some really simple things from physics to start out with, just to get across the idea of huge complexity that can emerge out of nowhere. Then I've talked about some simple human systems, racial segregation, bridges, etc. And then more sophisticated systems, markets. This is all very interesting. I think it's extremely important, and this is the way forward in all these systems. But there's a whole other area that I haven't touched on, but is maybe even more important. Financial markets, as important as they are to our lives, only make up one kind of tiny sliver of social science at large. So much of social science is understanding the real basics. Where do we get our norms of behavior, social norms that say we should cooperate in this situation, but not let ourselves be taken advantage of in another situation, and punish someone who we think has been transgressing the social norms. Where do those kind of values come from? Where do ethnic groups get their uniformity in their style of dress, their fashions, and the way they speak? How does that emerge in the first place? Where did it come from through history? There's a lot of evidence and a lot of people now working on this idea that all those kind of patterns are very similar to the patterns you see emerging in the system of those beads that suddenly goes past the threshold and you get interesting structure that emerges in the system. In this case, it's human beings, but again, we're following oftentimes fairly simple rules and